Hi everybody, it's Angela Parker with New American Funding again. You guys know me, but it's Monday, so we're going to talk about mortgages because that's what we do on Mondays. Let me start off by reminding everyone that we are doing an animal shelter drive right now where we're accepting canned food for dogs, cats, any kind of toys that they would like, or cleaning supplies for the animal shelter. We would really appreciate all of your donations, as would the animals, of course. Save all the puppies. We are accepting donations here at the office until the end of April. So, okay, now let's get down to the nitty-gritty of mortgages. Guess what? Rates are at a 2.5-year low. That is great news for you. Guess what that means? For everyone who has gotten a mortgage over the last several years, if you were to get that same mortgage today, your rates would actually be lower than you originally received. This is great news for buyers. It opens up a couple different options. So let's start with, what is a refinance? A refinance takes your existing mortgage and replaces it with a new mortgage. So let's say last year you got a mortgage and it was at 5.5%. And you would qualify for the exact same mortgage today at, let's say, 4.875. You take your new mortgage, you pay off your old mortgage with it, and then you have a new mortgage, but you have a lower rate, which means you're going to pay less interest over the next 30 years. So that would be amazing news. Everybody likes to save a little bit of money, right? Well, you also have another couple options. There's something called a cash out refinance, and that is where you take equity out of your home in the form of cash. Most common reason that people take cash out of their home equity is to do renovations on the home, upgrade the home, create more equity in the home. Let me give you a quick example of what that means. Keep in mind, in the state of Texas, we have an 80%, what's called an 80% loan to value cap on cash out refinances. For simplicity's sake, let's say your home is worth $100,000 and you owe $60,000 on it. You would be at a 60% loan to value. You could take up to 80. So you'd take $20,000 in cash, refinance a new $80,000 mortgage. You'd have $20K in cash and still only be at an 80% loan to value because your home would be worth $100,000. So that is a cap in Texas specifically. So let's say your home is appreciated in value. You bought your home 5 years ago. Your home, you bought it for $200,000. It's now worth $300,000, and you want to put $20,000 worth of renovations into the home. You are able to do that and likely qualify even for a better rate. Well, probably if we did 5 years ago, probably about the same, but within the last several years for sure. Another reason that I see a lot of people taking cash out of their homes, there's two more things, and one of them is to help pay for college. College is incredibly expensive, and we all like to be able to help our kids do things. So college education funds are a big reason that people take money out of their home, which is equity out of their home. And another reason is to consolidate their debt. Now, this is something I do want to be very clear about. Let's say you have credit card, let's say you got $10,000 in credit card debt at 16, 17, 18% interest. You could pay a minimum payment on those, and it takes you a gazillion years to pay off, right? Well, let's say you have some equity in your home. You want to take that, you want to pay off that 10K in credit card debt by taking cash out of your home, paying that higher interest rate debt off, and refinancing to a 4 to 5% rate. The thing to keep in mind here is take that extra cash flow that you were paying towards those credit cards every month and pay it towards your mortgage. Otherwise, you're just amortizing the debt over 30 years, right? And you're paying a lower rate on it, but you're paying it for 30 years instead of 5 to 10. So that's why it's so important that you work with a mortgage lender who will help you look at the numbers, see what you need to pay where, that's going to net you the most profit over an extended period of time. We call it managing your mortgage. Mortgage lenders shouldn't just go away when you're done financing your home. You should constantly be coming back once a year and say, let's manage my mortgage. Let's look at making my mortgage work for me instead of just pay a payment every month to the bank for 30 years and not think about it again. I think that that's probably about it. I had some notes written and I didn't even take a look at them today. But anyways, give me a call if you guys have any questions about refinancing. But that is the short version of it. And just keep in mind that there are always a right way and a wrong way to do things. So talk to your lender before you make a move. Bye, guys.